Okay, so similar to the finance lease example problem, we are going to do an operating lease example problem, and it does take quite a while to get through this one. It's actually a little easier than the previous example, but again, we're just going to kind of walk through it as best we can here. So again, we have a new example here. There's a lease that's signed on March 1st, 2020. There's a fair value of the equipment. We have semi-annual payments, so that's a little bit different. And the other thing that's a little bit different in this example is that the payments start immediately rather than at the end of each period, they're at the beginning of each period. And so, and in this case, the lessee has not guaranteed any residual value, so that, again, that makes a slight change to the calculations we saw in the finance lease example problem. Again, just as we always do, we have to evaluate the 5 criteria to suggest whether this should be a finance or an operating lease. As we look through the first 3, transfer of ownership, purchase option, and lease life, none of them suggest that this should be a finance lease. There's also nothing that suggests there's no alternative use for the asset upon its return. And so the only thing that's really left is to walk through the present value calculation to see if it's 90% or more of the fair value of the asset. If it is, then it suggests we should have a finance lease. We'll see. Again, the first step in the present value calculation is to calculate the implicit rate in the lease, knowing that the difference in this case is that payments occur at the beginning of each period rather than at the end of each period. So we have 4 semi-annual periods, so that's our N. The fair value of the asset at the time the lease is signed is $215,000. Again, this is from the lessor's perspective. They're giving that asset up. They're receiving payments of $18,000, and they're going to get the asset back at the end, and they believe it's going to be worth $165,000. And so the semi-annual yield on this lease is 3.08%. We take that semi-annual yield and the other information, and now we have to calculate the present value of the minimum lease payments. The N and the I/Y are the same, of course. The payment, instead of being positive, is negative because we're adopting the lessee's perspective, and the lessee has not guaranteed any residual value, so the FV in this calculation is 0. And so the present value of the minimum lease payments is $68,839. Of course, $68,839 is nowhere near 90% of the fair value of the right of use asset, and therefore this is an operating lease. All right, so with an operating lease, we still amortize the lease liability just like we would with a finance lease. In this case, we have that initial carrying value, we have the payments, and we have the inferred interest. Notice I don't have interest expense in that middle column because there's really no interest expense that's part of an operating lease. Rather, you're using the inferred interest to amortize the lease liability. One important thing to note here is that the first payment of $18,000 occurs immediately, and so there's no inferred interest, and so the entire payment goes as amortization of the lease liability. And so the rest of the schedule follows everything we've always done. You're just applying the discount rate to the previous carrying value, and that gives us our inferred interest. The amortization is the difference between the payment and the inferred interest, which goes as a reduction to the carrying value of the liability. Again, just as a note, the final carrying value of the liability is 0 because the residual value in the lease is 0. So this is where it gets a little bit different. So with an operating lease, rather than having a straight line amortization, you follow what's called a lease expense schedule. And essentially what it does, it allows the amortization of the lease asset to offset the amortization of the lease liability so that the lease expense is constant. And so in this way, basically we get an even lease expense over the life of the lease. We amortize the asset and we amortize the liability in a very similar fashion. You're going to see it's a little bit offset, but the idea is we're using that inferred interest that we calculated from the prior table in order to get the amortization of the right of use asset. And together that allows us to even out the lease expense over the life of the lease. I do want to note very quickly though, there's really no direct way to calculate the interest column. We're simply copying the column from above and applying it to the lease asset. This is very, very important. Do not try to calculate anything here. You're just copying it down. Okay, so the initial journal entry is just like we would have with a finance lease. We bring on the asset and the liability at the present value of the minimum lease payments. In this example, that present value is $68,839. There's that immediate payment of $18,000, which goes as a reduction to the lease liability, and of course there's the credit to cash to reflect the payment. So now the next step is on September 1st, 2020, we need to record that first payment. All of these amounts are taken directly from the lease amortization table, the lease liability amortization table and the lease expense schedule. They're taken right off of there. The only thing that I will note is that with the lease expense schedule, typically we use the end of a month rather than a beginning of the month. And so you'll see that August 30th, 2020 is the date on the lease expense schedule, but September 1st, 2020 is the date on the lease amortization schedule. And so again, these numbers are taken directly off of those two tables and they directly equal out. So the adjusting entry is where it gets a little bit complicated. Hopefully the easy part of this is that since the lease expense is even over the life of the lease, we simply need to accrue the portion of lease expense that was incurred between September 1st, 2020 and December 31st, 2020. And so that's 4 out of 6 months, which means the lease expense for that 4-month period is $12,000. Then we have to understand that we've moved down the lease amortization, the amortization of the lease liability. And so now we're looking at the time between September 1st, 2020 and March 1st, 2021. And our focus really is on that interest column. And so we know that we need to, again, we're accruing interest as a way to handle the lease liability account. And so that interest total would be 6 months. For 6 months would be $1,059. We accrue 4 months in 2020, and we accrue that amount to the lease liability account. This is just very similar to what we had done with a finance lease. And so this idea of accruing the interest to the lease liability is something we've done consistently. The only difference here, of course, is that we're not recording any kind of interest expense. Rather, the lease liability is included as a way to offset or even out that lease expense of $12,000. We're also moving down the lease expense schedule because we need the amortization of the lease asset as part of this journal entry. Again, the amortization is the amount that is amortized between August 30th, 2020 and February 28th, 2021. Again, 4 months of the amortization has taken place. And so we amortize the right of use equipment 4/6 of $16,941 for a total of $11,294. And so again, this is a little bit wonky, and I get the fact that there's really no strong intuition, but essentially, again, we're using the amortization of the lease liability and the lease expense schedule to allow the lease expense to be even over the life of the operating lease. So now we move into 2021. We're just moving down the table. So we're using that same line in the table that we used before. We're accruing the last 2 months of the lease expense. We're also now amortizing the lease liability, but now that lease liability amortization has 2 components. The interest that we had accrued, or the inferred interest that we accrued at the last fiscal year end, along with the amount from the amortization table of $16,941. We also have to amortize the remaining equipment amount, which the total was $16,941. We previously amortized $11,294, which means that we need to amortize $5,647 in the 2 months, basically January and February of 2021. Again, the whole idea here is that we're allowing the lease expense to be even over the life of the lease, and of course we do also need to record the cash payment that occurs on March 1st, 2021. And all of them will add up because the schedules are linked up through that inferred interest. So now we're kind of moving on now through time, and we have the next payment on 9/1/2021, and we're moving down the lease expense schedule as well. We take all the amounts from the tables, and hopefully this is a fairly straightforward journal entry. The lease expense and cash payment are the same. The amortization of the lease liability and the amortization of the right of use equipment are also the same. What's very important to note is that as of 9/1/2021, the lease liability account balance is zero, meaning that the lease liability is fully amortized. So the only thing left after 9/1/2021 is the lease expense schedule. And so in this case, there would have been 4 months that passed from 9/1/2021 until 12/31/2021. And so similar to the previous year, we need to record $12,000 of lease expense, and that's reflected as amortization of the right of use equipment, also of $12,000. And then finally, on February 28, 2022, we have the last bit of lease expense, $6,000. That's 2 months expense. And the last bit of amortization of the equipment, also $6,000. The residual value of the lease is zero, which means that the balance in the liability and the right of use asset is also zero. And so there's no final entry to remove those accounts off the books because their balance is zero at this point in time.